Hi students, welcome to DS Economics channel. Today we are going to discuss 2023 July Kerala State Eligibility Test Economics Previous Year question. This is your part number 2. In this part we are going to discuss from question number 41 to 80 question. So those who come for the first time, please subscribe to this channel for more such updates. This is your part number 2. So let's start the video. I have already uploaded the previous videos, so if you want to solve the previous videos, I have given the link in the description and create a playlist for Kerala set, so you can watch the playlist. So today's first question is question number 41. Question is, choose the correct statements about Ricardo-Barrow effect. So there are 4 statements. We have to choose what are the correct statements for the Ricardo-Barrow effect. So what is Ricardo-Barrow effect? You have to know first what is Ricardo-Barrow effect. So Ricardo-Barrow effect, also known as Ricardian equivalence, is an economic theory that explores the relationship between government spending, taxation and aggregate demand. So it is the relationship between government spending, then taxation. It is the relationship between government spending, taxation and aggregate demand. The relationship between government spending, taxation and aggregate demand is called a Ricardo-Barrow effect, and it is also known as a Ricardian equivalence. So let's analyze each statement to determine which ones are correct. So first statement is an economic theory that suggests that when a government tries to stimulate an economy by increasing debt financed government spending, aggregate demand will increase. So by analyze the first statement, it says that Ricardian equivalence posits that when a government increases spending by borrowing, or we can say debt financing, rational consumers anticipate future tax increase to repay his debt. As a result, they increase their saving to prepare for the future taxes, which offset the increase in aggregate demand that the government spending might have created. Therefore, according to this theory, aggregate demand doesn't increase with debt finance government spending. So here, aggregate demand doesn't increase with debt finance government spending. So here, this statement is incorrect. So by analyzing this statement is incorrect. Then come to the second statement. Second statement is an economic theory that suggests that when a government tries to stimulate an economy by increasing debt finance government spending, demand remains unchanged. So by analyzing the second statement, it says that this statement accurately reflects the core idea of Ricardian equivalence. It suggests that consumers adjust their savings behavior in response to increased government borrowing, leading to no net change in aggregate demand. So here aggregate demand is unchanged. So it is a correct statement according to the Ricardo-Barrow effect. Then next, statement 3, we have to analyze the statement 3. Statement 3 is taxpayers will save to pay the expected future taxes. This will tend to offset the macroeconomic effect of increased government spending. So statement 3 says that this statement aligns with Ricardian equivalence. It is also aligns with the Ricardian equivalence. It states that taxpayer anticipate future tax liabilities resulting from current government borrowing and accordingly increase their saving, which neutralizes the stimulative effect of the government's increased spending. So here option number 3 or statement 3 also right here. Then fourth statement, Ricardian equivalence maintains that government deficit spending is greater than spending out of current taxes. So here says that government spending is greater than current taxes. So by analyzing the statement 4, Ricardian equivalence actually asserts that the method of financing government spending, whether through debt or current taxes, has equivalent effect on the economy. So debt or current taxes, it has equivalence effect. So it doesn't claim that deficit spending is greater than spending out of current taxes. So it doesn't claim. So here it on the statement 4 is also incorrect. So here statement 2 and statement 3 are correct for Ricardo-Barrow effect. So only 2 and 3 are correct. So right option is only 2 and 3. So option C is the right option, because Ricardo statement, Ricardo-Barrow effect, it is known as Ricardian equivalence, and it is an economic theory that explores the relationship between government spending, taxation and aggregate demand. So here according to this statement, option number statement number 2 and 3 are correct. Then question number 42. Question number 42 is Paul A. Samuelson is closely associated with Samuelson theory, indifference curve, characteristic of good approach, risk related consumption, or revealed preference theory. So Samuelson is closely associated with revealed preference theory. Revealed preference theory given by P.A. Samuelson. So according to our preference, we reveal our preference according to our choices. So it is called as revealed preference theory given by Paul A. Samuelson. Then next question, Gaussian's first law is also known as the law of dash. Gaussian's first law: substitution, equimarginal utility, diminishing marginal utility, consumers equilibrium. So Gaussian's first law is also known as diminishing marginal utility. DMU, diminishing marginal utility, is also known as Gaussian's first law. And you have to know that Gaussian's second law is equimarginal utility. Gaussian's first law is diminishing marginal utility, and Gaussian's second law it is called as equimarginal utility. So here question asks for first law is diminishing marginal utility. Then question number 44, the total substitution effect of a price change is equal to. So substitution is equal to price effect minus substitution effect, or price minus income, or substitution minus income, or substitution plus income. So we know that price effect is equal to income effect plus substitution effect. So when we calculate substitution effect, so substitution effect is equal to price effect minus income effect. So here price effect minus income effect. So the total substitution effect of a price change is equal to price effect minus income effect, because price effect is equal to income plus substitution effect. So when we calculate substitution effect, we deduct from price effect. So price effect minus income effect is equal to substitution effect. So here B is the right option. Then question number 45, L-shaped isoquant implies perfect substitutability of factors, perfect complementarity of factors, fixed proportion production function, variable proportion production function. First one is perfect substitutability of factors. When factors are perfect substitute to each other, the isoquant line is become straight line. Straight line means perfect substitutability of factors. When perfect isoquants or factors are perfectly complementary to each other, its shape is L shape. So here L shape means perfect substitutability between perfect complementarity of factors, and perfect complementary shows fixed proportion production function. So fixed proportion means there are some fixed proportion for the two goods. Like when you give an example of bike, so here two tires consist a bike, or we take an example of car. So car has 4 tires, so the combination of car and tires is equal to one car. is equal to 4 tires. So it is a fixed proportion production function. And perfect complementarity of factors. So when fixed proportion production function and perfect complementarity factors arise, the shape of the isoquant is L shaped. So here option number 2 and 3 are correct, and variable incorrect, perfect substitutability incorrect. So here option 2 and 3 are correct option. So option D, here option D is the right option. Only 2 and 3 are correct according to the L shape of isoquant. Then question number 46. A monopolist marginal revenue is dash when the elasticity of demand curve is equal to unit. When the elasticity of demand is equal to 1, at that time marginal revenue curve, what is the shape of the marginal revenue curve? 0, negative, positive, or intermediate. So here to show the figure, we draw a diagram. We know that in monopoly market AR is downward sloping and MR is half of AR, MR curve, and elasticity of demand arise where MR is equal to 0. Question asks for when here when MR is equal to 0, here elasticity of demand is equal to 1, and before the position of suppose it is called as A, before A ED less than 1, and after the point E ED greater than 1. So when a monopolist marginal revenue is 0, here MR is equal to what? MR, value of MR is equal to 0, and when marginal revenue is 0, at that time the elasticity of demand curve is equal to unity. When elasticity of demand is equal to 1, marginal revenue value is equal to 0. So here marginal revenue is 0. Then next question 47. Cross elasticity of demand will be 0 when a given change in price of good X brings about dash in the quantity demand of good Y. So here cross elasticity of demand 0. So cross elasticity of demand is equal to 0 when there are no change in the quantity demand of good Y. When X price changes, quantity demand of Y remains same. So at that time cross elasticity of demand become 0. So here cross elasticity of demand will be 0 when a given change in the price of good X. When price of good X, suppose good X price rises and good Y price remain constant. When good Y's price remain constant, price of good X rises, it is called as cross elasticity of demand will be 0. Because when you find out the cross elasticity of demand with respect to Y, so change in good Y by change in good X, change in good Y price. So good Y's price change is 0 and good X price something suppose 10. So 0 by 10 is equal to 0. So 0 by something is equal to 0. So here it brings no change. So when the price of good X brings about no change in the quantity demand of good Y. When price increase or decrease but good Y price remain constant, at that time cross elasticity of demand will be 0. So here right option is option number C. Then question number 48. Which of the following statement about given goods is wrong? We have to find out the wrong statement about the given goods. Given goods, you know, given good is the exception of law of demand. When price increases, demand also increase in case of given goods. So its slope is upward sloping. Like when price of a goods rises, its demand also rises. It is called as given goods. So first option is option number A. A given good is a type of good which demand increases as price increases. This is right option. Positive slope. when demand increases, price increases, and when demand price decreases, demand also decrease. So vice versa. So it is also right. Then second statement, a given good has an upward sloping demand curve, which is contrary to the fundamental law of demand. So fundamental law of demand curve is downward sloping, but given goods, in case of given goods, it is upward sloping. So it is also right, option number B. Then third option, option C, demand for given goods is not influenced by a lack of close substitutes and income pressures. No, according to given goods, this is incorrect. Then option number D, Veblen goods are like given goods but with a focus on luxury item. Yes, this is also right. Given goods, when price increase, demand increase. Veblen goods also a type of good. When price of goods rises, its demand rises. But in given goods, we take the case of inferior good, but in case of Veblen goods, we take the luxurious items. But the slope of two curves are same. In Veblen goods also, when price increase, demand increase, and in case of given goods, it is also when price increase, demand also increases. But in Veblen good, we take luxurious item, and given good, we take inferior item. So this is the difference. So D is also right. A, B, D, these are right statement according to given goods, but C option is incorrect. So here only C is incorrect. So here C is the right option. Then question number 49, the elasticity of substitution in a Cobb-Douglas production function is equal to 0, unity, infinite, greater than unity. So elasticity of substitution in Cobb-Douglas production function is equal to unity or 1. We can say 1. The elasticity of substitution between two goods is 1, because alpha plus beta is equal to 1. Then which of the following is not a feature of monopolistic competition? We have to find out the which is the not feature of monopolistic competition. First one is selling cost. Selling cost found in monopolistic competition. In advertisement, selling cost is there due to advertisement. And second one is excess capacity. Yes, in monopolistic competition we found excess capacity, but in perfect competition there is no excess capacity, but in perfect monopolistic competition we found excess capacity, because we cannot produce at the minimum of the average cost curve. Average cost curve minimum point is here, but we produce in other points. So we produce here or here. So the gap between the minimum point and other point is called the excess capacity. So here excess capacity found in monopolistic competition. Then reaction curve and product differentiation. No, a reaction curve is not related with monopolistic competition. Then fourth one is product differentiation. Yes, the main characteristics of monopolistic competition is product differentiation. The main difference between perfect competition and monopolistic competition market is in monopolistic competition market product differentiation, we saw product differentiation, but in perfect competition market we see there are homogeneous product. So product differentiation is also a characteristics of monopolistic competition. So here not a feature of monopolistic competition is option number C, reaction curve. Then question number 51. Question number 51. The classical economist who stated that the market is like a lake agitated by the wind, where the water is incessantly seeking its level without ever reaching it. So this is the statement of 𝙁𝙍𝙀𝙀 or Walras. So this is the statement of Leon Walras. Classical economist Leon Walras define this statement. So it is the statement of Leon Walras. Then next question number 52. Continuous oscillation of price and output is a feature of dash model. So continuous oscillation between price and output is a feature of Carnot duopoly, Bottent, Edgeworth or Chamberlain. So it is not found in core knot, bottent, but in Edgeworth model, duopoly model, we found the oscillations of price and output. So there is a feature of oscillation of price and output arise in the Edgeworth duopoly. So your right option is option number C. Then question number 53, the wedge fund theory was introduced by J.S. Mill, Walker, Malthus or Adam Smith. The wedge fund theory was introduced by J.S. Mill. So here right option is option number A. Then 54 number question, velocity of circulation of money was determined by money supply, frequency of transaction, credit facilities, all of this. So velocity of circulation of money, means for what time money transact from hand to hand. So this is called as velocity of circulation of money. So it is determined by money supply. So by money supply, the velocity of circulation of money increases. So it is determined by money supply. And frequency of transaction, it is also determined by frequency of transaction, how many times the money transact from hand to hand. Then credit facilities, when credit facilities, greater credit facilities, greater velocity of circulation of money arise. So here velocity of circulation of money was determined by all the factors. So here D is the right option, all of the above. Then question number 55, measure of the money supply M2 is equal to. So there are 4 measures of money supply, M1, M2, M3, M4. M1 is equal to C plus DD plus OD. Then M2 is equal to M1 plus saving deposit with post office saving. So post office saving bank, option first one is all post office deposit. No. Time deposit, no. Time deposit comes under M3, but M1 plus saving deposit of post office saving bank, only saving deposit of post office saving bank. All post office deposit is not under the M2, but in M2, M1 plus only saving deposit of post office saving banks include. So here option number C is the right option. Then next question number 56, super multiplier is equal to. We know the simple multiplier k is equal to 1 by 1 minus MPC, or we can say 1 by MPS. So 1 by MPS. But here question asks for super multiplier known as k dash. So super multiplier is equal to super multiplier, option number A is the right option, 1 by 1 minus B minus I. So here 1 by 1 minus B indicate, here small b indicate MPC, marginal propensity to consume, and small I indicate marginal propensity to invest. So B is equal to MPC and I is equal to MPI. So here super multiplier is equal to, super multiplier known as K dash is equal to 1 by 1 minus B minus I. So option number A is the right option. Then question number 57, a lemon problem refers to the issues related with the valuation of an investment or product due to moral hazard, asymmetric information, adverse selection, none of this. So what is lemon problem? Lemon problem is a type of selling of old car in US market. When old car in US market, there was a market called as lemon market. In that market, all the old cars are sold, buy and sold. So old car market is called as lemon market, and in that market there are mainly arise asymmetric information. Asymmetric information means there are two parties, buyer and seller. So here buyer has more knowledge than the seller has more knowledge than the buyer. Buyer has less knowledge and seller has more knowledge. So in some cases seller may exploit the buyer by different technique. So here asymmetric information arises in the lemon market. So seller knows what are the defects of the old car. So when he found any type of defect in the old car, so he is eager to buy that car. But when a buyer try to buy a car, he doesn't know about the defects of the car. So seller have more knowledge, so seller may exploit the buyer. So it is called as asymmetric information. Asymmetric information means one party has more knowledge than the other party. So here asymmetric information arises. Then question, so in asymmetric information there are different condition like moral hazard, adverse selection, but main problem is asymmetric information. So here right option is option number B. Then question number 58, the Marshall-Lerner condition states that the trade balance improve following a devaluation or real depreciation of the currency if the sum of the export and import elasticity is greater than 0, greater than unity, greater than 2 or less than unity. So according to Marshall-Lerner condition, they said that trade balance improve following a devaluation or real depreciation of the currency. So devaluation or depreciation of the currency means by knowingly we devalue the value of our currency or depreciate the value of the currency, and when we depreciate, our export rises and import falls. So the balance of trade improve. So here if the sum of the export and import elasticity is that is when it balance of trade improve, its value of the export and import elasticity is greater than unity when we devalue or depreciate the currency. So here export rises and import falls, so the net value or net elasticity of value greater than unity. Then next question, question number 59. The impossibility trinity refers to the dilemma that a country cannot simultaneously have dash. So impossibility trinity means it refers to the dilemma that a country cannot simultaneously cannot improve the three conditions, these three conditions at a time. So what are they? Question number 59, according to first one is fixed exchange rate, independent fiscal policy and open capital account. Then second one is fixed exchange rate, independent monetary policy, open current account, no. Then third one is flexible exchange rate, independent monetary policy and open capital account, no. Then fourth one is fixed exchange rate, independent monetary policy and open capital account. Yes, this is the right option. According to the impossibility trinity theory, it says that we cannot simultaneously have fixed exchange rate, independent monetary policy and open capital account. We cannot achieve these three we can say concept at a time or simultaneously. At a time we can fix the fixed exchange rate, independent monetary policy, but not open capital account, or we can say second and third, not first, or we can say first and third, not second. So here impossibility trinity refers to the option number D, fixed exchange rate, independent monetary policy and open capital account. We cannot achieve these three concepts simultaneously. Then question number 60. In the ISLM model, supply of the money is assumed as, according to ISLM model, so supply of money, according to ISLM model, supply of money is a increasing function of the level of income, decreasing function, or exogenously given. Yes, so according to ISLM model, supply of money is assumed as it is exogenously given. So D is the right option. Then question number 61, the sacrifice ratio is an economic ratio that measures the effect of rising and falling of dash. So what is the ratio of sacrifice ratio? So inflation on a saving in an economy, or inflation on a country's total production and output, or investment on a country's total production and output, or money supply on a country's total production and output. So here question asks for sacrifice ratio is an economic ratio that measures the effect of rising and falling of inflation on a country's total production and output. So what is the effect of rising and falling of inflation on a country's total production and output? When inflation rise, what is the condition of total production and output? And when inflation decrease, what is the condition of total production and output? So this is called as the sacrifice ratio. So option B is the right option. Then question number 62, the point at which aggregate demand curve intersect with aggregate supply curve, it is called as effective demand, excess demand, deficit demand, or warranted demand. When aggregate demand intersect with aggregate supply, so the point is called as effective demand according to Keynes. The point at which aggregate demand and aggregate supply interaction point, it is called as effective demand. So in effective demand, what we desire we get, so it is called as effective demand. So option A is the right option. Then question number 63, question asks for which of the following statements on the psychological law of consumption is not correct. So psychological law of consumption given by Keynes, so we have to find out the incorrect option. First one is when the total income increases, the consumption expenditure of the commodity will also increase. It is correct, but less than proportionately. Yes, it is says that when income increases, consumption also increases, but less proportionately. Means in what percentage income increase, consumption increase, but less than proportionately. It is correct option according to the psychological law of consumption. Then second option is marginal propensity to consume is less than 1 but greater than 0. Yes, marginal propensity to consume value is less than what but greater than 0. This is also correct. Then option number C, an increment of income will be equally divided between saving and consumption. When income increases, it says that when income increases, it is equally divided between saving and consumption. Means when income increases, it equally divide between consumption and saving. No, this is incorrect according to psychological law of consumption. Keynes said that when income increases, the percentage of consumption decreases and percentage of saving increases. We cannot divide equally between consumption and saving. So if we say income increase from 1000 to 5000, so we cannot divide the 5000 rupees into income consumption 2500 and saving 2500. No. So according to Keynes, when income increases, the percentage of consumption decreases. Suppose consumption is 1000 and then saving is 4000. So the ratio of saving increases and ratio of consumption decreases when income increases. So option number C is the incorrect statement. Then option number D, an increase in income will thus lead to an increase in both consumption and saving. Yes, when income increases, both consumption and saving increases, but percentage of consumption increase less proportionately and consumption of proportion of saving increases more proportionally than the previous. So this is correct. So option number A, B and D are correct. So here only option number C is the incorrect statement. Then question number 64, national product by factor cost is less than national product by market price by the amount of. So the national product by factor cost is less than the market price. How? In market price we include net indirect tax, but in factor cost tax doesn't include. So generally factor cost price is less and market price is more. We can take an example like when national product at factor cost price is 100, but when it finally goes to the market, then in factor cost market price added, so it now the price is 150. So in 150, 50 rupees are added in the name of indirect tax, net indirect tax. Net indirect tax means indirect tax minus subsidy. So when we add indirect tax and if any kind of subsidy find, we deduct the subsidy. So it is called as net indirect tax. When we deduct net indirect tax from market price, we got factor cost. So here option number D is the right option. Then question number 65, mathematical question. Find the AC and MC from the following cost function. TC, here TC is given, so we have to find out the AC and MC. We know that from TC, if we divide AC is equal to TC by here X, so TC by X or TC by quantity. So 15x square by X and 10x by X and 60 by X. So here 1x deduct, then x cancel, then 60 by X. So here AC is equal to 60 by X plus 15x plus 10. So AC is equal to 60 by X, 15x plus 10. So here right option is option number A. Then MC is equal to TC by Q. So MC is equal to TC by Q or TC by, we can say here X with respect to TC, del TC by del Q or del TC or DTC by DX. We have to find out the derivative of total cost. So derivative of total cost, derivative of TC is equal to, here derivative of TC is equal to 15x square, derivative is 15 into 2, 30x plus 10 plus 0. So it is 30x plus 10. So 30x plus 10 is MC is equal to 30x plus 10 and AC is equal to 60 by X plus 15x plus 10. So this is the right option, option number A. Then question number 66, high powered money is. High powered money means currency held with public and cash reserve ratio of banks. So currency with banks, no, currency with public. Option number B is the right option, currency with public plus cash reserve ratio of banks. So high powered money means currency held with public and cash reserve ratio. B is the right. Then question number 67, the phrase neutrality of money was introduced by Australian economist 𝙁𝙍𝙀𝙀. So neutrality of money given by Frederick A. Hayek. Neutrality of money introduced by Australian economics Frederick A. Hayek. Then question number 68, Okun's law postulates the statistical relationship between a country's 𝙁 and 𝙁. So Okun's law postulate what says? Okun's law says that when unemployment inflation rate, employment economic, unemployment economic growth rate, investment economic growth rate. Now according to Okun law, it is the relationship between unemployment and economic growth rate. So unemployment and economic growth rate, the relationship between a country's unemployment and economic growth rate is known as Okun's law. Then question number 69, organic composition of capital as per the Marxian theory of economic development is OCC, organic composition of capital. So organic composition of capital, it is known as C by C plus B. So it is known as organic composition of capital, C by C plus B. Then which of the following is not a component of HDI, Human Development Index? So here we have to find out the not a component of HDI. First one is life expectancy, So according to HDI is equal to, it is the combination of three factors, that is life expectancy index, educational attainment index plus standard of living index by 3. So first one is life expectancy, then second one is educational attainment index, then third one is standard of living index or real per capita income. So infant mortality rate is not included in the HDI, it is included in the PQLI method, but in HDI life expectancy, educational attainment and standard of living are included. So here option number C is the right option. Then question number 71, according to 𝙁𝙍𝙀𝙀 𝙀𝘍𝙀𝙀, an innovation may consist of innovation theory given by Schumpeter. So innovation consists of, first one is the introduction of a new product means innovation, right? Then second one is the introduction of a new method of production. First one is introduction of new product and second one is introduction of a new method of production, it is also right. Then third one is exploring existing market. No, exploring existing market is not comes under the innovation. Then conquest of new source of supply of raw material, yes, this is also correct under innovation. It is also the conquest of new source of raw material, we found the new source of raw material. So first one is new product, new method of production and new source of supply of raw material are included in innovation theory given by Schumpeter. So option number 1, 2 and 4 are correct. So 1, 2, 4 are in the option number B. Then question number 72, critical minimum effort theory was put forward by. Critical minimum effort theory given by Levenstein. So here right option is option number C, Levenstein is the right option. Levenstein given the critical minimum effort thesis. Then Lewis given unlimited supply of labor, Rosenstein-Rodin big push theory, Hirschman unbalanced growth theory, Levenstein critical minimum effort theory. Then question number 73, economic development with unlimited supplies of labor. Unlimited supply of labor given by Arthur Lewis. So W.A. Lewis is the right option, economic development with unlimited supply of labor. Then according to Harrod-Domar model, the warranted rate of growth given the incremental capital output ratio depends on. So here warranted rate of growth given the incremental capital output ratio ICOR depends on, we have to find out what are the factors depends warranted growth rate. Warranted growth rate depends on rate of growth of labor force or marginal productivity of investment or rate of growth of capital or saving income ratio. Yes, warranted growth rate depends on saving income ratio. So D is the right option. Then question number 75, the concept of zero based budget was given by. Zero based budget was given by Peter A. Pryor. Peter A. Pryor given the concept of zero based budget. Then question number 76, Fisher's ideal index number is the geometric mean of the dash. So Fisher's ideal index number is equal to Laspeyres into Passez, root over of Laspeyres and Passez. So Laspeyres and Passez methods. First one is Marshall-Edgeworth, no. Second one is Marshall-Edgeworth index and Laspeyres index, no. Third one is Laspeyres and Passez index. Yes, this is the correct option for Fisher's ideal index number. So Fisher multiply both Laspeyres and Passez method. So option C is the right option. Then question number 77, the standard deviation of a sampling distribution of a statistic is called probable error, standard error, calculated error or coefficient of variation. So here question asks for standard deviation of a sampling distribution of a statistic. So standard deviation of a sampling distribution of a statistics, it is known as standard error. So option B is the right option, standard error. Then question number 78, which of the following statements are correct in respect of Niti Aayog. So we have to find out the correct statement according to Niti Aayog. NITI, National Institution for Transforming India. Niti Aayog, it is a constitutional body, it is a statutory body, it is neither a constitutional body nor a statutory body, it is a think tank. So option number 4 is right, it is a think tank and it is neither a constitutional nor a statutory body. So it is a think tank of India. It resolved planning commission, then in replace of planning commission Niti Aayog come. So here option number 3 and 4 are right according to Niti Aayog. So option number C is the right. Then question number 79, assessment and reason. First one is assessment. Environmentally sound policies do not harm the environment or deplete the natural resources. So it is right. Environmental sound policies do not harm the environment and do not deplete the natural resources, do not exploit the natural resources. It is right because it is environmentally sound policies, so it cannot harm the environment. Then second one is sustainable development is critical to well-being of human society. Reason. What is the reason behind environmentally sound policies? It is sustainable development is critical to well-being of human society. This is also right, but this is not the exact reason for environmentally sound policies. So option 1 and 2 both are right, but reason is not the correct explanation of assessment. So 79, B is the right option. Both A and R are true, but R is not the correct explanation of A. Then question number 80, today's last question. Harrod model suggests that if G greater than GW and C less than CR, there will be. G means natural growth, actual growth greater than warranted growth. So actual growth, when actual growth is greater than warranted growth, it create inflation. So when actual growth rate is greater than warranted growth rate, or we can say actual capital less than required capital, it create chronic inflation in the economy. So actual greater than warranted, so it create chronic inflation or a huge amount of inflation in the economy. So option number C is the right option. So this is all about the today's session. So I hope all of you enjoy the video. So if you like, please like and comment in the comment section and share with your friends so that all are benefited from this video. You also please subscribe the channel for more such updates. In the next video we are going to discuss its part number 3 or last part of July set. Then we come to the different year set, Kerala set. So all of you, thank you for watching the session. Thanks.